Stock markets across the United States hit record highs in 1929, even while unemployment lines stretched 4 blocks outside factories that had stopped running. Investors in New York City counted paper profits at their mahogany desks, while workers in Detroit and Chicago carried empty lunch pails home through dark streets. Welcome to the Market Antiquarian, where history and finance reveal how the world really works. Subscribe to stay informed. The paradox of rising markets during economic collapse is not a modern mystery. It is one of the oldest and most misunderstood patterns in all of financial history. To understand why this happens, you must first understand what a stock market actually measures and what it does not measure at all. A stock market does not measure how well ordinary people are doing. It measures how well the largest companies and their shareholders are doing. These are two very different things, and the gap between them has existed for as long as stock exchanges have had trading floors and ringing bells. In the summer of 1929, the Dow Jones Industrial Average climbed past 380 points, a level that astonished every financial newspaper in the country. Steel production was slowing in Pittsburgh. Farm incomes were falling across Kansas and Iowa. Yet the ticker tape in New York kept printing higher and higher numbers. Historians who studied this period closely found that corporate profits for large industrial companies remained strong even as rural communities collapsed. This was not a coincidence. Large companies had found ways to cut costs by reducing worker wages and squeezing suppliers, and their balance sheets reflected that. The gains on Wall Street were built on the shrinking wages of workers who could no longer afford to buy the very products those companies were making. This internal contradiction was visible to economists like Irving Fisher at Yale University, who studied the production data coming out of American factories. But the stock market did not price in that contradiction. It priced in the profits, and the profits looked healthy on paper for a very long time. This is the first great lesson of financial history. Markets can stay disconnected from economic reality for months and sometimes years before they correct. The mechanism that keeps markets elevated during hard times is not mysterious once you break it down into its simple and visible moving parts. The first mechanism is what economists call flight to equities, where large investors move their money into stocks because other options look worse. In periods of economic stress, bond yields often fall because central banks cut interest rates to try to stimulate growth in the broader economy. When bond yields fall, the returns from holding government debt become less attractive, and institutional investors shift their capital toward corporate stocks. This wave of money flowing into equities pushes stock prices higher even when the underlying economy is weakening and unemployment is rising across the country. The New York Federal Reserve cut interest rates 3 times between 1927 and 1929 to help stabilize the British pound and support international gold flows. That rate-cutting policy flooded American markets with cheap money, and much of it went directly into the booming stock market on Wall Street. Brokers on the floor of the New York Stock Exchange watched order volumes surge month after month as new investors entered the market with borrowed funds. Margin buying, where investors borrowed money to purchase stocks, became so widespread that total margin loans reached $8.5 billion by late 1929. Borrowed money amplifies gains on the way up, which is why markets can rise so sharply even when the real economy is sending clear warning signals below. The second mechanism is corporate buybacks and dividend payments, which concentrate wealth at the shareholder level even as the broader workforce faces cuts. Companies that are laying off workers and closing factories often use the savings from those cuts to return cash directly to their shareholders. This was visible in the 1920s, and it has been visible in every major market boom since then, repeating the same pattern across different decades and continents. United States Steel Corporation reduced its workforce by over 20% between 1927 and 1929, yet its stock price continued to rise on the New York Exchange. The company used its labor savings to maintain dividend payments to shareholders, who reinvested those dividends back into the market and pushed prices even higher. The third mechanism is index composition, which is perhaps the most counterintuitive of all the forces that keep headline market numbers elevated for so long. When weak companies begin to fail during an economic downturn, they are quietly removed from major stock indexes and replaced with stronger performing companies. This replacement process means the index always shows you the best performers, not the full picture of the market, which includes many companies that are struggling. By the time a struggling company is removed from the Dow Jones or another major index, its losses have largely been hidden from the headline printed number. This is why the market number can look healthy, while hundreds of smaller companies and their workers are experiencing genuine and worsening economic distress. Understanding index composition helps explain why newspaper headlines about market records often tell a very different story than what workers experience daily. The fourth mechanism is currency debasement, which is one of the most important and least discussed drivers of elevated asset prices in troubled economies. When governments print large quantities of new money to fund spending programs or pay debts, the purchasing power of each unit of currency falls over time. As the currency loses value, the prices of real assets, including stocks, land, and commodities, tend to rise in nominal terms to compensate for that loss. This means that a stock market rising 20% in a year, where inflation runs at 18%, has produced almost no real economic gain at all, but the headline number says 20% higher. And that number dominates the news cycle and shapes how most people perceive the health of the economy. Germany in 1923 provides one of the most extreme historical examples of this disconnect between nominal market numbers and real economic conditions on the ground. The Frankfurt Stock Exchange Index rose to astronomical levels during the hyperinflation crisis. With nominal stock prices increasing by trillions of percent, workers in Berlin carried wheelbarrows full of paper marks to buy bread, while newspapers reported that German stock markets were reaching new record levels. The stock gains were entirely nominal. They reflected the collapsing value of the currency, not any real increase in economic activity or corporate productivity. The same dynamic, though less extreme, appeared in Argentina, Venezuela, and Zimbabwe during their respective currency crises at various points in modern times. In Argentina, during the early 2000s debt crisis, the Merval Stock Index in Buenos Aires continued to rise in peso terms, even as the economy contracted sharply. Citizens who understood that their currency was losing value bought stocks as a store of value, pushing prices higher in nominal peso terms every single week. This behavior is rational from the individual investor viewpoint, even though the broader economy is clearly in distress and ordinary people are suffering greatly. The fifth mechanism is the concentration of ownership, which determines who benefits when markets rise and who is left completely behind when they do not. In the United States, in 1929, approximately 1% of the population owned over 70% of all financial assets, including stocks, bonds, and real estate. When markets rise under those conditions, the gains flow almost entirely to a small group at the top of the wealth distribution, not to the broader population. The average factory worker or tenant farmer in 1929 had no stock market exposure at all. Market records meant nothing to their daily lives or weekly wages. This concentration of ownership explains why rising markets and rising poverty can coexist without contradiction in a single economy at the same moment in time. The people who own the assets celebrate the records. The people who do not own the assets do not feel the gains and may not even notice the headlines. President Herbert Hoover pointed to rising stock prices in his public statements during 1929 as evidence that the United States economy was fundamentally sound. He stood before reporters in Washington, D.C., and referenced Dow Jones numbers as proof that confidence in American industry remained strong and unshaken. 3 months later, the market had lost over 40% of its value, and the Great Depression had begun in earnest across the North American continent. The lesson Hoover failed to learn was the same lesson that every generation must relearn for itself. Through its own painful experience with markets and reality, a rising market number is not the same thing as a healthy economy, and a healthy economy does not guarantee a rising market number on any given day. These two things move together sometimes, and they move apart at other times, and knowing the difference is one of the most valuable lessons in financial history. The year 1932 saw the Dow Jones Industrial Average fall to 41 points, its lowest level in the 20th century after years of being celebrated as a sign of prosperity. Thousands of investors who had borrowed heavily to buy stocks on margin lost everything they owned when margin calls arrived and they could not repay their debts. Banks in Chicago and Cleveland and Atlanta closed their doors permanently as losses. From failed loans overwhelmed their reserves, and deposits disappeared overnight. The Federal Reserve, established in 1913 to prevent exactly this kind of systemic collapse, raised interest rates in the early 1930s instead of cutting them. That decision, made by officials in Washington, D.C. who were trying to protect the gold standard, deepened and extended the Depression far beyond what it might have been. Milton Friedman and Anna Schwartz documented this policy failure in their landmark 1963 work, A Monetary History of the United States with Precise Statistical Evidence. Their research showed that the money supply contracted by 1/3 between 1929 and 1933, turning a severe recession into a decade of genuine economic catastrophe. The contraction did not begin because markets fell. Markets fell because the real economy had been weakening underneath the headline numbers for years already. The physical evidence was there in the steel mills of Pittsburgh and the cotton fields of Alabama and the wheat farms of the Great Plains long before the crash. Commodity prices had been falling since 1926. Farm bankruptcies had been rising across the Midwest since 1927. Small rural banks had been failing since 1925. But Wall Street was focused on earnings reports of large corporations, and those earnings still looked good, so the market kept climbing toward its fatal peak. This is one of the most important truths in all of economic history. The stock market is a forward-looking instrument, but it often looks in the wrong direction. It looks toward the earnings of the largest and most powerful companies while ignoring the slow decay happening in the foundations of the broader economy. By the time that decay reaches the balance sheets of major corporations, the damage is often too severe to be absorbed without a significant market correction. The crash of October 1929 was not a surprise to every observer. Economist Roger Babson had warned publicly in September 1929 that a crash was coming. He stood at a lectern in Massachusetts and told an audience of businessmen that the market was overvalued and that a serious decline was mathematically inevitable. The audience largely dismissed his warning. Stock prices were high, dividends were being paid, the ticker tape showed green. Why would anyone listen to doubt? This psychological dimension of market behavior is just as important as the mechanical forces we have already discussed. Throughout this historical narrative, human beings are pattern-seeking creatures who find it very difficult to accept negative information when the visible numbers around them still look positive. A worker who sees factory orders slowing will still point to the newspaper stock index and say the market would have gone down if things were really bad. This circular reasoning, where the market number is treated as proof of its own validity, has appeared in every major financial bubble in recorded history. It appeared in the tulip markets of Amsterdam in 1637, in the South Sea Company collapse in London in 1720, and in the railroad speculation of the 1840s. In every case, the visible number stayed high while the invisible foundations crumbled, and the correction came not gradually, but suddenly, and with great force. The suddenness of these corrections is itself a product of the mechanisms we described, because borrowed money and concentrated ownership both amplify the fall. When margin calls began in October 1929, investors who had borrowed to buy stocks were forced to sell immediately, triggering cascading waves of further selling. That cascade turned what might have been a correction into a collapse, and what might have been a recession into a decade of genuine hardship for millions. The New York Stock Exchange building on Broad Street stood silent in November 1929 as trading volumes fell and the great paper fortunes began to evaporate. Crowds gathered outside the exchange on Wall Street, looking at the boards and trying to understand how the numbers that had made them feel rich were now gone. The story of why markets stay high during collapse was not over in 1929. It would repeat itself in new cities, new centuries, and new forms of money. The pattern that destroyed fortunes in 1929 did not die with the Great Depression. It walked quietly into the next century and repeated itself with new faces. By the year 2000, a new generation of investors sat before glowing computer screens in San Francisco and New York. Watching technology stocks climb to dizzying heights, the Nasdaq Composite Index had risen over 400% in just 5 years, and the financial press called it the greatest wealth creation engine in American history. Companies with no revenue, no physical product, and no profitable business model were being valued at billions of dollars on the floor of the New York Stock Exchange. Pets.com sold pet food online and had lost money every single quarter since it opened. Its stock still rose over 100% on its first day of public trading. Webvan promised to deliver groceries across the United States and raised over $375 million from investors before it had ever turned a single dollar of profit. In rural counties across the Midwest and the American South, factory closures were accelerating as manufacturing jobs moved to lower-cost countries overseas. The unemployment rate in towns like Flint in Michigan and Gary in Indiana was rising steadily, but the Nasdaq kept printing green numbers on television screens. This was the same disconnect that had appeared in 1929. dressed in new technology clothes and celebrated by a new generation who believed this time was different. Federal Reserve Chairman Alan Greenspan had stood before Congress in Washington, D.C. in 1996 and used the phrase irrational exuberance to describe what he saw. He was describing a market where stock prices had risen far beyond what the underlying earnings of those companies could reasonably justify to any careful observer. The market ignored him completely. The Nasdaq rose another 200% after his warning, proving once again that markets can stay disconnected from reality for years. The mechanism driving that disconnect in 2000 was the same flight to equities seen in 1929, now amplified by a new invention called the 401k retirement account. The United States government created the 401k system in 1978, which automatically directed a portion of millions of worker paychecks directly into stock market funds. By 2000, over 50 million American workers were contributing to 401k accounts, and most of that money flowed automatically into technology-heavy index funds every month. This created a constant river of new money entering the stock market every 2 weeks, regardless of whether the broader economy was strong or quietly deteriorating. The technology bubble peaked on March 10, 2000, when the Nasdaq Composite reached 5,048 points, a level it would not reach again for another 15 full years. Within 18 months, the Nasdaq had lost 78% of its value, erasing over $5 trillion in paper wealth from brokerage accounts across the United States. Pets.com shut its doors in November 2000, just 9 months after its celebrated market debut, leaving investors with significant losses and warehouse workers without jobs. The physical economy had been sending warning signals during the entire climb. Credit card debt had reached record levels, while personal savings rates fell to historic lows. 8 years later, in the autumn of 2008, the same pattern appeared again on the streets of New York City and in the corridors of Washington, D.C. The Dow Jones Industrial Average had climbed to 14,000 points in October 2007, a record level celebrated on the front pages of every major financial newspaper. Underneath that record, home foreclosure filings across the United States had already been rising for 18 consecutive months in states like Florida and California. Mortgage lenders in offices across the country had been approving home loans for buyers who could not afford to repay them and bundling those loans into securities. Those securities were sold to banks and pension funds around the world, which held them on their balance sheets as highly rated, safe financial instruments. The ratings agencies in New York, including Moody Investors Service and Standard & Poor's, had given the highest possible ratings to many of these bundled securities. When the housing market began to fall in 2007, the value of those securities collapsed, and the losses spread to every institution that had purchased them globally. Lehman Brothers, a firm that had stood on Wall Street for 158 years, filed for bankruptcy protection in September 2008 with $613 billion in outstanding debt. On the morning of September 15, 2008, employees carried cardboard boxes out of the Lehman Brothers building on 7th Avenue in New York City, as cameras recorded. The Dow Jones Industrial Average fell 777 points on September 29, 2008, the largest single-day point drop in the history of the exchange up to that moment. Congress voted on a $700 billion rescue package for the financial system, and when the first vote failed, the market fell another 800 points in a single day. The rescue package eventually passed, and the Federal Reserve began purchasing assets from troubled banks in a program that became known as quantitative easing. Quantitative easing was a policy where the Federal Reserve created new money electronically and used it to purchase government bonds and mortgage-backed securities. This injected enormous quantities of new money into the financial system, which lowered interest rates and made stock market investments more attractive to large funds. Between 2009 and 2020, the Federal Reserve expanded its balance sheet from approximately $900 billion to over $4 trillion through asset purchase programs. That river of newly created money had to go somewhere, and a very large portion of it flowed directly into the stock market, pushing prices higher year after year. The Standard & Poor's 500 index rose over 400% between March 2009 and February 2020, one of the longest bull markets in the recorded history of American finance. During that same period, wage growth for the bottom 50% of American workers remained largely stagnant when adjusted for the rising cost of living and housing. The stock market was celebrating a decade of gains, while millions of working Americans were experiencing a decade of financial stagnation and rising household debt. Then came March 2020. and the world watched something that no financial textbook had fully prepared investors or policymakers to handle in real time. A global health crisis shut down physical economies across every continent simultaneously, closing restaurants, hotels, airports, and manufacturing plants around the world. The Dow Jones Industrial Average fell 37% in just 33 days between February and March 2020, the fastest decline of that magnitude in the history of the exchange. Unemployment in the United States reached 14.7% in April 2020, the highest level recorded since the Bureau of Labor Statistics began tracking the data. Lines of cars stretched for miles outside food distribution centers in cities including Los Angeles, Dallas, and San Antonio as families sought emergency assistance. And then, in the middle of all of this visible economic suffering, the stock market began to rise. It did not pause. It did not hesitate. It simply started climbing. The Federal Reserve announced on March 23, 2020, that it would purchase unlimited quantities of government bonds and mortgage securities to stabilize financial markets. The United States Congress passed the CARES Act on March 27, 2020, injecting $2.2 trillion into the economy through direct payments, loans, and expanded benefits. That $2.2 trillion was followed by additional relief packages totaling over $5 trillion across 2020 and 2021, the largest peacetime fiscal expansion in history. Surveys conducted in 2020 showed that millions of households who received direct government payments used a portion of those funds to open new stock trading accounts. The online brokerage firm Robinhood added over 3 million new accounts in the first quarter of 2020 alone, as Americans at home opened trading accounts on their phones. The Nasdaq Composite rose 43% in 2020, despite the worst economic contraction the United States had experienced since the Great Depression of the 1930s. Technology companies, including Apple, Amazon, Microsoft, and Alphabet, saw their market valuations rise by trillions of dollars during a year when millions lost their jobs. This was the logical outcome of every mechanism described in this story, all operating simultaneously at their maximum intensity during a single calendar year. The Federal Reserve had cut interest rates to near zero, making bonds unattractive and pushing institutional money toward equities and offices across Wall Street. Government payments had created new retail investors who opened brokerage accounts and bought technology stocks from kitchen tables in cities and towns nationwide. The major stock indexes replaced struggling companies with stronger ones, so the headline numbers reflected only the strongest surviving corporations on the market, and ownership remained concentrated. So the gains flowed primarily to institutions and wealthy households who held the largest portfolios of financial assets. The year 2020 was a near-perfect demonstration of every mechanism that has kept markets elevated during economic collapse throughout the entire sweep of financial history. History professor Robert Shiller at Yale University had developed a measurement called the cyclically adjusted price-to-earnings ratio to help identify overvalued markets. By late 2020, the Shiller ratio for the Standard & Poor's 500 had risen above 33. A level exceeded only once before in recorded history, in the year 1999. The last time the ratio reached that level, the Nasdaq fell 78% within 18 months. But in 2020, the money kept flowing and the screens kept showing green. This brings us to the deepest truth this entire historical journey has been building toward from its very beginning in the trading rooms of 1929. Markets are not thermometers that measure the temperature of the whole economy. They are mirrors that reflect the priorities of the people with the most capital. When central banks create money and lower interest rates, that money does not distribute itself equally across workers, renters, and small business owners on main streets. It flows toward assets because assets are what large institutions and wealthy households hold, and asset prices rise when new money enters those specific markets. The workers who lose their jobs in an economic crisis do not own significant stock portfolios. Their financial pain does not register on the Dow Jones Average. The small business owner who closes a restaurant does not appear in the quarterly earnings reports of Amazon or Microsoft. That loss is invisible to the index. The market is a precise instrument for measuring one very specific thing, and it measures that one thing with great accuracy and consistency over long periods of time. It measures the present value of the future profits of the largest corporations, as estimated by the people who have the most capital available to invest. Everything else, every human cost, every closed factory, every empty lunch pail, Every food line stretching around a city block sits entirely outside its field of vision. This is not a moral judgment about markets. It is simply an accurate description of what markets are designed to measure and what they are not designed to measure. Understanding this distinction is one of the most powerful pieces of financial knowledge a person can carry when reading headlines and interpreting economic news. When you see a headline saying markets hit record highs, you now know exactly what that sentence means, and more importantly, what it does not mean at all. It does not mean workers are thriving, that wages are rising, that small businesses are healthy, or that the foundations of the broader economy are sound. Roger Babson stood at that lectern in Massachusetts in 1929 and tried to tell a room of confident men that the number on the board was not the whole story. Alan Greenspan spoke the phrase irrational exuberance before Congress in Washington, D.C., and watched the market rise another 200% before correction finally came. Each generation receives the warning. Each generation finds a reason to believe this time is different. And each time, the fundamental mechanisms remain exactly the same. The tulip bulb traders in Amsterdam in 1637 and the South Sea investors in London in 1720 both believed the number on the board represented permanent and real wealth. The technology investors of 2000 and the traders watching glowing screens in 2020 shared one deep belief in common with every crowd that came before them in history. They believed that a rising number meant a healthy foundation. History shows, with remarkable consistency, that these two things are not always the same. The most powerful thing you can take from this journey is the ability to read two stories happening at the same time in the same economy simultaneously. One story is the story the market tells through its records and celebrated new highs printed on the front pages of every financial newspaper every morning. The other story is lived by workers in factories, families in foreclosure, and communities watching their economic foundations shift beneath their feet each year. Those two stories are sometimes the same story, and sometimes they are completely different narratives unfolding simultaneously in the same country at the same moment. Knowing the difference between those two stories is what separates informed observers from those who are always surprised when corrections arrive without any warning. The same paradox that confused investors watching ticker tape in New York in 1929 still challenges people staring at screens in trading rooms and kitchen tables today. The numbers keep climbing, the foundations keep shifting, and the gap between those two realities has defined financial history from Amsterdam to Wall Street and beyond. The past still has stories to tell. Subscribe and let us uncover them together.